So, you've divested from fossil fuel funding. Nice one. But who are you doing it for? Today, I'm going to use 120 biscuits to explain why your decision may benefit you, but not necessarily the climate. And then, maybe, we can start to identify some real green investments. As the theory goes, banks lend the money in your account to fund fossil fuel projects. And your pensions and savings may be enabling dirty companies to raise funds and expand by supporting their share prices. But now let's look into what's actually going on when you divest. And for that, we're going to need a simplified model of the finance sector. Cue the biscuits. The economy of biscuit land is worth 20 biscuits a year. But when this income is divided up, the workers take home 10 as wages, and the remaining 10 are divided up between the owners of capital as profits. But each of them will get a return according to what they invested in. So let's take a deeper dive into their decision process. They have two options. Invest in the oil company, which makes one biscuit in profit per year, effectively 10% of the economy, or invest in the everything else store, which makes 9 biscuits in profit per year. The plates represent the financial markets for shares in each company. Collectively, the Biscuitland residents have 100 biscuits saved, and they want to invest them. The first broker splits her 10 biscuit fund equally, making each company worth 5 biscuits. If no one else were to invest, she would earn a 20% return on the oil company shares and a 180% return on the everything else store. But these high returns will attract more capital, especially to the everything else store shares. So the next fund invests all of its entire 67 biscuit fund in this one, making it worth 72. Now the everything store profits are split between more capital, and the return falls to 12.5%. The last investor invests each of the remaining 23 saved biscuits in whichever company's returns are higher, until they converge in an equilibrium. In the end, the everything store is worth 90 biscuits and generates a 10% return, and the oil company is worth 10 biscuits and also generates a 10% return. So anytime an investor buys or sells, the prices adjust to equate the expected returns from each share. Yawn, nothing new there. But here comes the interesting bit. Let's imagine that the owners of half the capital decide to divest from the oil company for ethical reasons. So half of its market value is wiped out and it can't access capital cheaply enough to grow. Success! But sadly, we know that's not the end of the story. The unethical investors, now shown on this side, chase the higher returns from the oil company, boosting its value back up to 10 biscuits. They're now double as invested in the dirty industry, at 20% of each of their portfolios. Can we make a difference if we convince more of them to listen to their consciences though? Well, yes, but only if the percentage of capital controlled by unethical investors is less than the percentage of the economy made up by the dirty industry. For example, if 90% of investors decide to divest, then the remaining unethical investors will go all in on the oil company to maximise their returns. This won't stop the oil company from growing, but when just one more investor takes the leap to being ethical, it can start to tip the balance, because there's no more unethical capital to fill the gap. So, can we get to this point in real life? Theoretically, yes, but with fossil fuels representing around 8% of the FTSE 100, we would need to persuade 92% of asset managers to go green, and it would need to be even higher for most other indexes which are less exposed to oil. In contrast, a 2020 survey of global fund managers by Octopus Investment found that they only intended to divest 8.6% of their funds on average over the next 10 years. This frustrating effect also acts in the opposite direction, reducing the benefit to the climate from the sustainable funds which, for example, invest in renewable infrastructure companies. More ethical capital flowing in could be matched by an equal amount of profit-only capital flowing back out. If you want more solar panels, don't buy shares, buy solar panels. So it seems like we're fighting a losing battle. But one factor which may help to bridge this gap and exhaust the unethical capital flows is diversification requirements. many funds and investors may not be willing to be more than, say, 50% invested in any one sector. If this were the case for all Biscuitland investors, then we would only need 80% of them to go ethical, down from 90%. If any more of them decide to go green, then the remaining unethical investors will be tempted by the higher oil company returns, but they'll be constrained by their 50% exposure maximum. But unfortunately, in the real world, there are plenty of private equity buyout funds without strict diversification requirements, and they're eager to snap up any bargain companies. And to make things worse, our goal is an unstable one even if we do achieve it. To explain, let's go back to Biscuitland and imagine that 95% of capital has been divested. That means that the Everything Store shares are earning just less than a 10% return, while the oil company shares are earning a 20% return. This gap is what hurts the oil company's growth prospects by making it more expensive for them to raise money. But it's also what could tempt some of the less committed ethical investors back to the dirty side. It's a fight against human nature. But for now, let's give the Biscuitlanders the benefit of the doubt and assume that they do stick to their principles. Even if they do, the unethical investors will get richer at double the rate. Their excess returns, when compounded, could increase the proportion of unethical capital back up towards 10% in around a decade. As we've seen, it's pretty hard to curb the growth of fossil fuel extraction using the finance sector. And even if we can, there's nothing to stop them drilling as much as they like at their existing oil rigs. In fact, you can arguably have more impact by actually investing in oil shares. Make your feelings known at their AGMs and vote against expansion. If oil bosses don't have to answer to any ethical shareholders, why would they ever decide to clean up? But what about other examples of divestment in the real world? Have they worked? Many organisations have avoided tobacco investments for years. Did that make a difference? Well, no, or at least it's inconclusive, because large tobacco companies like Altria have been some of the best performing shares in the last 100 years. And even when the share price has fallen for a period, it's difficult to identify how much of that was due to divestment, amidst all the noise around falling demand and new health regulations. That leads us back to climate regulations, which will inevitably curb fossil fuel profitability in coming years. For that reason, it makes sense for you to divest, else you risk exposure to stranded assets. And by the same logic, regulations will support the profitability of green infrastructure. If you had invested £1,000 in the iShares Global Clean Energy Fund at the beginning of 2020, it would have been worth nearly £2,300 by the end of the year. But while it may be a sensible decision for you personally, you probably won't be doing the climate a favour. Luckily though, there's a much simpler way to stop funding fossil fuels. Stop buying them. The way to drop oil company share prices isn't by selling their shares, it's by not contributing to their profits. If the Biscuitlanders didn't expect any future profits from the oil company, they wouldn't fund it. So if you invest in sustainable funds but still drive a petrol or diesel car, then you're on the wrong track. This low interest rate environment is designed to stop you saving and get you investing. Real physical investing, not buying shares. You won't earn much in interest or dividends while asset prices are sky high. But the returns from switching to an electric car or installing a heat pump and solar panels could be over 10%. And more importantly, you'll be permanently eliminating CO2 emissions at source. Divestment is important, but unless you're a fund manager, it's not your job. It is your job to cut your own emissions, and that starts at home.